Hi there eToro, it is Monday the 21st of March and that means it's time to take a look at what moved the markets last week. I'm going to zoom through today's video because I spent a couple of hours with Gavin from the Copy Traders Club and a few other PIs. I'll share the link to that podcast when it's out, but hopefully it'll be quite interesting. The theme that we've seen each week of enormous volatility has not let up through the past week. We saw some enormous gains in my portfolio, but also in various different indices. So the Nasdaq was up 10, nearly 11% from the bottom. The Russell 2000 put in a gain of about 7.5%, S&P 500 up 7%, but the overall winner from last week was ding ding ding, KWEB. Now KWEB is an ETF of Chinese internet businesses, and we know that the prices from Chinese technology companies has been crashing for ages. It looks as though we might have found a bottom because those stocks were up 48%, or at least this ETF was up 48% from the bottoms over a period of 4 or 5 sessions. Now, before we go on, I wanted to talk about market structure. Market structure is not something you will hear investors like myself talk about very much. It is something that traders talk about quite often. I need to make a video that describes the difference between traders and investors. One is coming, but maybe not this week. Market structure is quite interesting. Even as an investor, I enjoy learning about different ways of skinning the cat, as it were. Market structure can be seen as a cycle. So accumulation is when the market is recovering from a bearish kind of phase. It's decided that it's gotten over that and now it's time to be bullish again. It is then followed by a markup phase, the bullish phase, distribution, when the market starts deciding maybe things have gone a little bit too far, or maybe there's some kind of event. For example, the Fed decides to hike, which changes people's minds, and then that's followed by a decline, which is then followed by an accumulation once again, and so on and so forth. Now, I don't believe that it is possible to time the market, particularly when you know that this type of thing plays out along many different time frames. So, I mean, here's a version of it here, here's a small version of it here, here's a bigger version of it here. So you never know exactly what part of it that you are in until, you see it in the rearview mirror. But if we do look in that rearview mirror, it does look as though we are starting to build what's called a base, which is a part of late stage 4 decline and the accumulation phase across various indices, but also across a number of stocks in the stock market. In fact, some of the hardest hit stocks seem to be turning upwards just a little bit right now, although things are still volatile, so who knows. Last week, I also put out a post. I had thought that my videos were conveying my thoughts about the market and my portfolio, etc., to my copiers on eToro, but I don't think I was being specific enough. I think I talk about these things, but I don't talk about performance head on. And my copiers were unhappy about that, and rightly so. So I put together this post that describes my long-term performance, what I'm going to do about it, my strategy, etc. I will pin this post on my eToro feed, but I've also realized that I need to put out a video version of this once in a while. So I might do it every month or every 2 months. The thing is, I'm a long-term investor, so not much is going to change in terms of my strategy and my approach and my portfolio composition week to week. So it doesn't make sense to do it every week, but maybe it does every month or every 2 months or so. I'll figure that part out. I did want to touch on 2 areas of this post while I have you. So everyone would like the returns to be large and exactly the same year to year, but that is not the way the market works. Particularly if you're trying to achieve outsized gains, you usually are going to hold companies or participate in sectors that are fairly volatile. Volatility is the price you pay for outsized gains, is a saying you might have heard. So these types of returns over 5 years, this is a lot more lumpy, and there's a big negative return in here too, but the outcome is more or less the same as this kind of slow and steady. People can't really achieve the same number year after year after year unless they're going for pretty low returns overall. So sometimes there is some pain, and sometimes that pain can go on for a while, but we can't force the stock market to do what we want it to do. What we can do is buy companies that are good, strong companies that are performing well, and even if the stock market goes up and down, eventually the value awarded to those companies should hit more or less where we expect it to. Now, in terms of my strategy, I'm a long-term bottom-up investor, so I prefer to not entirely ignore everything that's going on around the edges. For example, in terms of macroeconomics, I'm obviously aware of what's going on macroeconomically. You see me talk about it week in, week out, but the most important factors within a company that I choose to invest in will be the specifics of that company. So not only the financial fundamentals of that company, what are the profit margins like? Are they generating cash? Are they growing? Are they profitable? Is revenue growing? Do they have too much debt, etc.? I like to know about the company owners, the people running the company, the product lines, the strategy. Do they have a history that shows that they know how to execute and that they've been successful so far? Also, a lot of the time, there are companies out there that the market doesn't understand entirely because they're fairly young. Let's say they're 5 years old or so. But because of my particular business background, I feel like I do understand what they are doing, and I think that they are bound for success. Within my portfolio, I hold 28, 29 stocks. So from that perspective, my portfolio isn't particularly concentrated, but those companies tend to fall into only a few different kinds of industries. And I've chosen these based on the type of growth that I expect from those industries. So for example, payment companies or online retailers or e-commerce businesses. These are all areas of the internet that have experienced pretty big growth through 2020, overshot a little bit. The prices have come back down to earth, and now I expect that they will continue to compound for years and years and years to come. Right now, you can buy quite a lot of these types of companies for very cheap. In some cases, their relative price compared to blue chips is much, much cheaper. You can buy high growth compounding technology companies that are profitable, in some cases for cheaper than Coca-Cola. All right, but enough about that for today. In terms of the portfolio, so we saw some big jumps in the numbers last week. Today, we're seeing a big drop in the types of companies that I own, and I'll talk about why in a moment. But I've taken a lot of flack for some of the companies that have rebounded the strongest through last week before they rebounded. And I think this is part of the reason that people copy me. So I understand these businesses, and I have deep conviction in the value of these companies and the growth that they're going to experience. So when the market misprices them and they drop by huge amounts, I'm willing and able to hold on to those companies, knowing that the stock market was wrong. And that at some point in the future, I don't know exactly when, the stock price will catch up to the business fundamental. All right, so what caused all of these bounces that we saw through last week? Well, the first was the much anticipated meeting with the Fed. So we saw the Fed interest rate decision and some information about rate hikes through this year. No real surprises there. The Fed was quite hawkish, but the market has been priced in so much negativity and there's been uncertainty that I think it's celebrated having, exact numbers and measures to work with, and this fueled some of the bounce. The other is that after China saw the huge drops of the past few weeks, the government came out and said, listen, we're going to do this better. We're going to not only support our economy and stock market, we're going to increase clarity and consistency so that investors inside the country and outside the country can have more confidence in our markets, the stock market and other markets. And obviously investors loved the sound of this, and we saw the big jumps from last week. Now, hopefully we can see some follow through and a bit more in terms of specifics of what the government is going to do, but it's, a good start. All right, what about this week? So stocks, a lot of stocks have fallen quite hard today. In part, I think we're seeing some profit taking from last week after the enormous jumps through last week, but also the prices of commodities are once again spiking. So wheat, oil, various metals and chemicals are going to be in short supply as long as the war in Ukraine is going on. So fertilizer prices are hitting a new high. Russia is one of the largest suppliers of fertilizer in the world, and commodity prices are through the roof. So once again, like we've seen many times over the past few weeks and months, there's a rush to safety out of so-called riskier assets, although I'm not sure why, for example, Salesforce would be risky when it comes to wheat prices. But that's, the market is not completely rational, and there's been a rush to safety. these kinds of sectors and also those types of companies that are somehow involved directly or indirectly with commodities. We're not seeing a hell of a lot going on in terms of US macro data points coming out this week. There are some interesting data points out of the UK, so CPI inflation numbers will be very interesting to get our hands on. And we've seen some nice surprises out of the UK in terms of PMI data recently. I want to see if that continues. Just a reminder, as long as these numbers are higher than 50, it means that the economy is in an expansion phase and not in recession. Other than bits and pieces of macro data, I think we're going to see more of the same that we've seen through the past few weeks. Headlines will be dominated by the war in Ukraine, as well as the various effects that we might see in the global economy. Something specifically that is causing the price of oil to surge today is that there's fears that the EU is going to ban Russian oil. So for those people sitting in oil positions, long oil positions today, you've seen a nice little pop. Now, something that I wanted to point out is that this is not the first time we've seen prices of commodities spike. It happens every now and again. It's always good to go back to history when these types of things happen. So this is the chart for Brent crude going back to, is it the 80s, 90s? And we can see several sharp short spikes in the price of oil. And if I had a different commodity up here, we would see a similar kind of thing. The reason I wanted to pull this up is that a long-term rise in the price of commodities is going to be a strong driver of inflation. Now, we've only just recently started getting over the supply chain issues. There still are supply chain issues, but they're getting to a point where they're workable and supply chain issues should start easing, and that part of inflation at least should start coming down. But now with the war in Ukraine and shortages of various things out of those economies, we're seeing another spike. And if this is sustained, then this will be yet another driver for inflation, obviously. The reason I want to go back to history is to point out that when we have seen a short, sharp rise in the price of commodities, it is often followed by a very sharp decline in those commodities. This might take, a few months to play out, but, this has been going on, the rise has been going on for a few months now already. This is one reason why I do not trade the macro situation. It can turn on its head very, very fast. But also this tends to give me some hope. So inflation is an ongoing concern, although now there's also a concern that we could have a recession. If interest rates are going up and inflation is going up, that might force the hand of various governments around the world, which means that interest rates will rise, economies will slow down, and we will enter a recession. However, if we look back at history, it is likely that this spike will not be sustained and go on forever, but that the price will reverse at some point and we will see a sharp decline on the other side, taking some of that pressure off of inflation. All right, that's it for this week. I do plan to add funds to my portfolio in Etoro on the 1st of next month. There are just so many stocks that are so cheap right now that I want to have some extra cash on hand in order to buy them up. I'll create a video detailing what I'm going to do, when I'm going to do it, and what your options are, and I'll post that this week. All right, speak to you soon. Goodbye.